GM. GM. This is February monthly preview. Looking ahead at the month to come. So we've had January. January started off, if you remember, all the way back with hype for the ETFs. So January's open was here. We opened the year at 42,251. Rallied up into the ETFs. Then we had the launch of the ETFs. We had the sell the news narrative, which in reality was just profit taking, not so much the ETFs causing it. We know this because of the inflows, right? So there's been net inflows. If you look at what's come in here. So total flows net 1.46 billion. That was for the first 14 days, trading days. So Grayscale 5.6 billion out. iShares, so BlackRock and Fidelity, iShares and Fidelity Wise Origin, 2.7, 2.4. Then the smaller ones, ARK and Bitwise, both with about 650. Invesco, Galaxy, with about 300, and then the rest with less. But all that matters is the total flows, excluding GBTC 7.1, but including GBTC 1.46. So it's just not correct and is not accurate at this point to say that the ETFs have been a net negative. They have been a net positive to over $1 billion. And that's important because when it launched, some selling came in. Now there was Grayscale selling for sure. There was FTX estate dumping their GBTC shares, absolutely. But more than anything, what we saw was an unwind of one of the best trades of the year. Right? So you got long in August at 25, you're able to dump it at almost a 2x. Everybody dumping at 80% plus. And so just in general, the trade in anticipation of the ETF is still in the process of unwinding. So we sold off from 49 down to 38.6. We swept out those lows, came back inside, and we're now back inside this range. That has led us to a monthly, which throughout the month, and you want to look at the perception of people, the perception of this monthly candle changed significantly throughout the month. So this was December's candle as we get into January. So here was January. Started off bullish, looking really good, looking amazing going into the ETFs. Then the ETFs launch. Then we started looking like dog shit, all the way down as low as 38.6. Monthly candle looked terrible, but bulls rescued it right into the close. So there we have, after all the up, all the down, all the flip-flopping of opinions, we end up right back basically where we started with a monthly doji candle. Doji is where it opens and closes around the same level. So signals indecision, and in an uptrend I would expect that month to be followed by a consolidation month and then eventually continuation. So I would look at that and say on a weekly we had a nice reversal, so we're holding back inside. We're probably going to push a little bit higher, but overall I would see us trading between 38 and 49, or 39 and 49, let's call it, for a little bit of time as the market sorts itself out. When we see that, you can see it from the drawing that I've done and the main chart that I've been following really all the way along, which is two ranges. Range 1, 39 to 49, with pivots at 40.8 and 48,000. So we went below that pivot, got back above it, we're now back inside. Doesn't mean we have to go to 48, but that would be the upper end where you'd see real strong selling. I expect us to go to 44, 45 at some point this month and probably meet some spot selling around that area. And everything else kind of in between is just going to be a little bit noisy and probably something to just stay, keep yourself level-headed, understand that the Bitcoin ETF is a huge, huge, huge event that opens up a massive pool of capital, and we have the Bitcoin halving coming in April. I'll talk a lot more about that one on March's monthly preview as we get closer. But we've got positive catalysts coming up, and for all the, the sentiment really shifted. Like if you look at the fear and greed index, which is not something you would trade off of alone, but it's one useful metric among others. You can see on the fear and greed index, if it loads, which it doesn't seem to want to do for whatever reason. Let's try that again. Right. Let's check the fear and greed. Wonder why that is. Fear and greed. Crypto fear and greed index. Oh, you're just getting rugged here by the fear and greed index. They are getting rugged. We will get it. No need to worry. Oh, fantastic. No. Cool. Guess that's rugging me. So we'll just do the old-fashioned way. Crypto fear and greed now, just touching back into greed, but it's more the rate of change. Last week, we were 49. So we're actually below neutral, heading towards fear. Having been at extreme greed, we were up in the 80s going into the ETF itself. So we had a nice shift of sentiment. You know this just from reading online. It was, bears doing victory laps, talking about sell the news and how every bull's a retard. If you remember back, if you go and watch my 2024 plan and my 2024 outlook, the number one thing I said with regards to the ETF is that it's just noise. It's all noise. Everything is noise on Bitcoin below all-time high. It's all a dip to buy. It's all a bear trap. When you zoom out, the market is heading in one direction and everything is still supporting that, from the Fed, the Treasury, liquidity, the election year, stock market looking good. Nothing has changed from that perspective. There have been some, this week just gone, we had the FOMC. So the Fed decided to keep rates steady at 5.5%, which is what we expected. But a lot of talk has been coming in about the Fed saying that or Powell, when he was asked in the press conference, saying that he's not going to hike rates in March. That's not what he said. What he actually said was, the reporter asked him, are you going to lower rates, I should say, not raise. Are you going to lower rates in March? And he said, that's not our base case. That's not a no. That means it's basically another political non-answer, saying that's not our base case. So that's not what we're intending to do. If the meeting was today, we would not. But that's obvious. So I think the market has gotten itself a little bit over excited on the bear side about, oh, this is really bad. But think about it. The Fed are always data dependent. This is what they say now, right? Every time there's a meeting, Powell says, we will assess the incoming data. We will make decisions based upon the data that comes in, and all this typical political speak, right? So when you think about it like that, what does that mean? Well, it's really like Powell saying, we're going to take our position based on the incoming data, and if inflation changes, if growth expectations change, if the market looks good, if the market looks bad, they're going to reassess every month or every couple months, depending on when the meeting is, based upon inflation expectations, GDP, growth of the economy, employment. And the Fed has a dual mandate: price stability and maximum employment, meaning keep inflation 2% and keep people in work. That's their official mandate, right? So I think the futures markets, which project the Fed rate cut or rate hike probabilities, have overcorrected. A lot of people are actually saying they're undercorrected. But if you look at this, back in December, even at the start of January, there was a 20% chance that they would hold rates in March. there is now a 65% chance. So that's the market saying, in January we thought it was almost nailed on that the Fed were going to cut interest rates in March, in the March meeting. Now we think it's actually far more likely that they hold them steady. There's only a 35% chance that they'll cut, 65% chance that they'll hold. But there's plenty of reason to suspect that they will cut in March still. I think people have really misinterpreted what Powell said. Just like in December, the market got really excited when there was that really dovish Fed meeting. And dovish is like bullish, hawkish is like bearish. When you talk about monetary policy, dovish and hawkish are the words they use instead of bullish and bearish. Because dovish and hawkish is not bullish or bearish. Dovish is bullish for stocks and crypto, but it's not bullish for, let's say, bonds or yields or expectations in other markets. So, in a really simple sense, the market is now looking at what Powell said and taking that to mean, oh, you're not going to cut rates in March. But he said base case. That is not our base case. So when you combine the fact that he said it's not what they're planning to do right now, that's obvious. If they didn't cut in January, based on all the data, and the expectation was 97%, they're not going to cut in January, and that was completely right. That's because, inflation's coming down, but it's not back at 2%. The economy's strong, unemployment's low, and really they can say, look, everything seems to be okay. We're in this kind of Goldilocks phase where growth is strong, employment market looks fine, and inflation's coming down, but it's not back to 2%. So if in January the Fed said, there's not enough here for us to cut rates, and then a reporter asks a question, will you cut in March? And he says, that's not my base case. That means we need to see more data, right? If they weren't going to cut in January, and then you ask him in January, how does he feel? He's going to say, I don't feel like cutting, right? That's, at least for me, that's the logic that I apply to it. And to me, that makes sense. Whether it's right or whether it's wrong, that's another matter. I'm certainly not always right, but I hope you can see the logic behind what I'm saying. And it's not about whether they'll cut or whether they won't cut. It's all about the expectation. What does the market think? So there are decent odds that things get a bit worse before March and actually push them towards cutting. You can see this now with renewed stress in the banking system. So March this year would be exactly 12 months since the banking crisis, where Silicon Valley Bank collapsed, Silvergate, Signature Bank, they both went under. And the Fed had to roll out the Bank Term Funding Program, BTFP, in order to set up the markets to not collapse. But we're seeing now a renewal, but in a different way. So there's a tweet here by Arthur Hayes talking about a Japanese bank, Aozora. And he says, while the Fed won't cut, they can change eligible collateral required to include CRE, which is commercial real estate. That is back-end money printing, but optically they can claim no rate cut due to strong economy. So one of the biggest things that has been on my mind and that I want you to focus on is the rate itself doesn't really matter, right? The actual interest rate is not super important. Why? Because it takes, at least in the short term, it takes 12 months for rate cuts to be felt or rate hikes to be felt. And it's far more about what are they doing with actual liquidity, which we'll talk about in a second. And two, what is the expectation of future rates? So whether it goes to 5, whether they cut in March or whether they don't cut in March, the path is already clear. He all but confirmed, and there's a 90, the percentage of a cut coming, right? So cut starting. In May, it's now 92% chance that cuts will start in May. In June, there is 0% probability of rates staying where they are, right? Even at the lowest end, they're expecting just one cut by June. But the totality of the data is saying that by June, we are cutting rates. So cuts are coming. based on the market. And these are futures markets. This is traders. This is actual supply and demand. This is people betting. This is not economists who are always wrong. The market is very rarely wrong in totality because there's money on the line. It's just like a bookmakers who does sports betting. If you see a bookies or a casino or whatever, you never see a broke bookie, right? You never see a bookmaker going out of business. Very, very, very rarely. It's usually mismanagement that makes a betting shop or a betting bookmakers or a sports betting, whatever you call it in your country. It's very rarely the actual odds because they have teams. They have fucking huge amounts of data. They have actuarists who are calculating all these probabilities, sports based. They have all the smartest minds to try and figure out the best odds, the most accurate odds for whatever outcome it is, and then they build in an edge for themselves to make sure that they stay in business and that the average bettor loses money, right? Casinos, sports, it's all the same. So when you leave it to the market and the market pricing, it's usually quite accurate. So I would look at it and say, has the market overreacted to what the Fed said? I think so. Because if rate cuts are coming, and maybe it's March, maybe it's May, maybe it's June, but they're coming. And then you look on the other side at liquidity, and liquidity is still rising. So looking at this Capital Wars, the newsletter that Prof. Adam talks about a lot. Major central banks' liquidity is expanding at 4.5% annualized clip. So this was as of yesterday. Central bank liquidity in aggregate across the world is increasing. They are stimulating. They are net increasing liquidity. That's all that really matters. That's the headline that matters. So whether the Fed are talking about rate cuts, not rate cuts, whether the Treasury are talking about the QRA, and all these things we talked about last week, what matters is liquidity is still rising. Liquidity conditions are still positive. And liquidity is what drives these markets. So if liquidity is still rising, and then you've got this potential contagion where Aozora, which is a Japanese lender, Aozora, is absolutely wrecked. Down to 3-year lows. Based upon real estate, so commercial real estate loans. And then you have New York Community Bank, absolutely trashed as well. The last time these were this low was in the banking crisis last March. What happened last March? Whenever things got this bad, the Fed stepped in. Now, this is different than the Bank Term Funding Program, which is going to expire in March, but the current round of bank weakness is based around commercial real estate, which is not provided for in the BTFP. So what this means is, and it's very nice and neat in my opinion, it means there's now a new scary issue that allows the Fed to create some new mechanism for what is just money printing, but they can say it's not this, it's that. They're not going to outright come out and say we're printing money. That's politically bad. But what they can say is, due to the stress in the commercial real estate sector, which is destroyed because of COVID, right? In COVID, everyone's offices shut down. They sent people home. If you have 100% of people who used to work in offices, now at best, you've probably got about 60-70% of those people actually back in work. In many places, it's way lower. Most people, once they got the chance to work from home, they want to keep working from home. And the companies, especially if you had a job and you did it for a year at home and you were still productive, it's really hard for the company to say you have to come back in. You're like, well, my productivity was just as good at home, if not better. So yeah, I know you want me to come back in, but I'm not going to come back in. If you don't like it, I'll get another job. Right? And so the best employees can demand that. What does that mean? Well, that means roughly any office space that was had by all these companies is maybe at 70% capacity. Therefore, they don't need the same office. They need to downsize. Or else they're just paying for empty space. And when you take that, if that's one company, that's nothing. But when you take that across every company across the world, the demand for commercial real estate and these office units is way lower than it was pre-COVID. And that has taken time to be felt. Right? COVID happened, 2020, 2021. Then we had the 2022 kind of bear market and contraction of liquidity. Now it's really being felt because interest rates risen in 2022, and there was, if you were a company and you were paying off a real estate loan based on lower rates, but it was on a variable rate, now you're paying a higher rate for your offices. If you're whatever, if you bought an office building or you bought a block or you bought units or whatever, you're still paying that off. You're paying it off at a higher rate and you're using less of it. That's just a clusterfuck of bad debt and underutilization. And so now it's really being felt. This commercial real estate crash is very real. And the Fed are going to have to step in, like they always do, especially in an election year. The last thing that anybody wants in an election year is for commercial real estate to fucking blow up and send people broke, into bankruptcy, in debt, out of jobs, and just destroyed. Are they going to vote for Biden if they've just lost everything in the year of the election? No. So you have then overlay this into crypto where it matters. Let me just phrase it extremely simply. Any banking stress is good for Bitcoin. Bitcoin was created for this reason. This was the March 2023 banking crisis. Initially, a sell-off, of course, because it was scary and there was USDC was depegging and it was all looking bad and it was uncertain. And then boom, Bitcoin just rips. Then a few months later, BlackRock ETF, Larry Fink on TV saying Bitcoin's a flight to quality. Everyone talking about how Bitcoin is the best way to hedge against the risk of the banking sector and of the shady practices they do. And here we are. So any banking stress is good for Bitcoin. It might not be great for stock market, right? If the stock market is at all-time highs like it is, and then there's a commercial real estate collapse and the Fed don't step in, that's not going to be good for stocks. That's not going to be great. It's not going to be good for other crypto either. Every other crypto is just a speculative, essentially the same as a stock. They're just speculative companies. But Bitcoin itself was created in direct response to the mismanagement, the shady practices, the outright scam and fraud in the banking sector. We saw this in March. And that's why I don't think you're going to see another March 2023 where Bitcoin goes that low, because the game is already clear, right? We already know what's going to happen here. So people will already be positioning in Bitcoin, and I wouldn't be surprised to see Bitcoin remain stronger than the market, even if there is this commercial banking issue. So Bitcoin can go lower, sure. In terms of the low time frame trading, I talk about that in daily levels, and I'll talk about it here. So the global liquidity, the main big picture, is still positive, still rising. The actual policy, right, the rate itself, what the Fed says about rates, is not as important as what they're actually doing. And then you've got this overlaid, the Japanese bank, which is contagion risks and is exposed across the world. It's not just in Japan. They're operating globally, as well as this New York Community Bank, and of course, God knows what else. I don't know how the regional banks are doing. Not great, right? But not terrible, right? It's not like they're back in 2023 levels where they were just collapsing. But there's signs of stress in the banking system here, which again is just going to stimulate or at least push the Fed towards a policy of supporting the markets. So there's a few things that Q1 going into Q2 can offer some, usually a bit of rocky price action, because you got a few different things. You've got January's out of the way now. So January usually has a positive effect in a bull market because at the start of the year, people's collateral gets re-rated in the stock market and they pile it back into stocks again because your stocks are up. Like if you have money in the Nasdaq last year, you were up you absolutely smashed it, right? You were up where's the end of the year? You're up 50-60%. And so as January comes, you are now much wealthier than you were in January, right? When January 23, January 24, you have a lot more wealth on paper, and you can take that collateral, you can borrow against it, and usually that flows into the stock market in January. February, we're now in, those flows end, right? So the actual January flows are gone. It doesn't mean the market has to go down or go to zero, but that supporting flow is gone for the time being. And next we look forward to tax season in the US, which I think peaks in April. And for that one, you want to watch the Treasury, the TGA, Treasury General Account, which is rising at the moment as the Treasury takes in tax receipts. So people are having to, especially with the ripping bull market we had in stocks, if stocks are at all-time high, if businesses are doing well, if the economy is strong, US investors, US employees, US just everyone in America, they're going to have to pay more in tax. But they made more money. However, for that little period, that means they have to maybe sell down some things or not invest because they have to allocate money, 10, 20, 30%, whatever it's going to be, cap gains or income tax or whatever, over into paying off their taxes. And so it can be, for a little period, there's a bit less, new money to flow into the markets. That can take us all the way through the rest of the quarter. So don't be surprised if the first quarter is rocky and shaky for the stock market, but then you overlay that and say, does that apply to Bitcoin? No, not really. Right? Bitcoin is not necessarily aligned with that. A lot of people still think that Bitcoin trades like a risk asset, but it doesn't. It hasn't done since the start of 2023. Bitcoin is traded much more like gold than it has anything else. Obviously with extremely much higher beta and much higher returns than gold. But if you overlay BTC gold, right? Probably have to do gold on not on a percentage chart, but price scale. And then let's just do the S&P. You'll see this, that as you go through 2023, the correlation of Bitcoin and stocks was actually the lowest it's been in years, right up until kind of the end of the year when everything was rising. But the much better and closer price action comparison was Bitcoin and gold, as you can see here. So after FTX collapse, gold rise, Bitcoin rise. Gold fell, Bitcoin fell. Gold rise, Bitcoin rise. All the while, stocks were broadly doing the same thing. But in the middle part of the year, you saw a bit of a divergence, right? Bitcoin was going down as gold was going down. Stocks were going up. So that's just showing you, that's telling you just the correlation. Bitcoin and gold were going down. Stocks were rising. Then, again, gold kept going down. Bitcoin kept going down and sideways. Stocks going down and sideways. And then towards the end of the year, gold up, Bitcoin up, stocks up. But the correlation is much, much, much stronger between Bitcoin and gold. And that makes sense because they are essentially the hedges against monetary debasement. If it's an anti-money trade, it's Bitcoin and gold, right? That's the way to look at it. And so when you go to gold itself, I think gold is setting up, I was going to say gold USDT. No need to do that. Gold is setting up quite nicely here. You want to always look at gold on the high time frames. It's a very slow moving thing. But gold liked what it heard this week from the QRA and from the Fed. Nice positive week being put in. Still just consolidating. And I think gold will then make its way to a breakout at some point this year. Again, you don't want to hold your breath on that. But overall, it's pretty bullish and the setup is good. Now, just from a cycle perspective, if you go back to Bitcoin, it doesn't mean that everything's just going up only from here and there's no stops. When you have an extended rally, you also have some period of cooling off, right? So from the very lows of the FTX collapse to the very peak after the hype of BlackRock, Bitcoin was up for 245 days. It then sold off into the lows for 35 days, but until it broke out again, it was 100 days. Right, so if I mark that one in red, you had a nice extended rally on BTC, followed by a shorter correction, but still 100 days. Then we had another rally. If you want to take it again from the lows or from the breakout, it's up to you. You can take it from the bottom, but I'll take it from the breakout. Whenever Bitcoin actually got out of this consolidation, which was in this week, we rallied up for how many weeks? 77 days, right? 11 weeks. And now we're only 3 weeks in, going into our 4th week of consolidation. So more than anything, I just expect a bit more sideways, maybe even for another 6 or 8 weeks. And that opens up possibilities for sure for Bitcoin to have, and I'll look at the halving briefly here. I won't go too deep in it. for Bitcoin to have some positive price action, not right now, but going into the halving. So we are basically 3 months away from the halving. So if you go back 90 days from the halving, where are we here? 90 days, there we go. Maybe I'll go to a daily chart for this just to make it clear. So 3 months before the halving, Bitcoin's price rallied up, chopped sideways, and then the big rally began exactly 53 days before the halving. We peaked out before the halving and sold off. And price was lower into the halving, but of course, in the months leading up to it, we had a strong rally. Right? Let's go again to 2020. Let's look at 3 months pre-halving. That actually takes us before COVID. 90 days. So at this point, we had the big COVID crash. And then, I think almost the exact same, 60 days pre-halving, rallied all the way up and sold off just before the halving. So it's really, let's call it 50 to 60 days if you're using the past, which doesn't predict the future, but it's and I won't look at 2012, 2016, 2020 is fine. Past doesn't predict the future, but the halving currently is set to be on the 20th of April, right? That's the current date for the halving. If we go back 90 days, that takes us to here, right? So there's our 3 months pre-halving. If we go to 60 days, that takes us to the 20th of Feb. And then if you go kind of between 50 and 60 days, like we were showing on those two examples, that's somewhere in that range. That's where you could see, most likely, if it follows the past, which it won't follow the past exactly, that's where you most likely see your bottom having formed. And so I think we can go up, we can go down, we can go sideways. And I think at that point, we start to grind up into the halving, maybe sell off before it, whatever. But I would say the big rally for the halving is yet to come. I don't think it just goes straight from here. I think that there is, as there typically tends to be at bottoms, some kind of retest of this bottom, whether it's a double bottom, whether it's a higher low. I think there's going to be something, and we're not quite in that phase yet, right? We're not quite in that 2 month period before the halving where it really kicks into overdrive. We still have a bit of time for choppy price action. I think we go up first. I think we test 44.45, and I do think that because of the nature of this breakdown and where the previous resistance was, I do think there'll be some spot selling this when we first reach it. Probably takes us back to the lows, consolidates, and then away we go. I just think people calling for 38, 36, 34, 32, I just think the timing is against them. If that was going to happen, this breakdown needed to continue, right? Because the longer it takes now, I mean, it's not impossible. We could break down this week and head down there, absolutely. But if that doesn't happen, if I'm here next week on Weekly Outlook, if I'm here next month on Monthly Preview and we're still in these areas and we're somewhere above 40, anywhere above 40, then that's where we're going to kick off most likely that halving rally. I want to look at the Deribit options. There's a couple of options expiries that matter, which is the end of this month, but then March, end of the quarter. This is telling you what options traders are betting on. So end of the month, where are we at now? We're currently around 43. So there's decent OI of options at 44 and at 45 and at 50. If we go lower, 37 would be the absolute lowest. You'd expect support there. 44 seems like it'll probably get breached. Depends how the first half of the month goes, right? The first half of the month is where you usually see the directional move on Bitcoin, up or down. But if we get to the 10th, 12th, 15th of February, wherever we're at, the options then come into play, and that's usually where we'll ping pong. So if we can get above 45, we probably trade between 45 and 50 for the rest of the month. If we can't get above 45 by the middle of the month, I would say it's quite likely that Bitcoin stays trapped between 40 and 45, or just doesn't get above 45. Lowest 37, somewhere around 45. That has played really well in December, if you remember. That's how I got my bias for December, which was Bitcoin sideways, alts up, and that played out well. January, same thing. Said that Bitcoin would trade between 42 and 50. Bitcoin ended up trading slightly lower than that, but then reclaiming 42 on the day of the expiry, like we mentioned. That was the basis of my long trade. And then that's one thing. But February itself, there's the end of Feb. is big, right? The big monthly expiry's always got a lot of open interest, but the end of quarter, that's the big one. Quarterly, especially, which is end of March, end of June, end of September, and end of December. They're the quarterly expiries. They're the big ones. So if we go ahead to the quarterly expiry, we've got massive open interest at 50 and again at 45. So this is our quarterly target. Can we reach 50? Traders are certainly betting on it, but there's a 40k big wall as well. So that to me for the quarter is looking like really, really, really solid support. So 40k, if we just remain above 40 and we're heading towards 50, that seems like the trading range for me. When I combine that with the fact that we've had an uptrend, and we drag this now over to look at just, you've got the halving over there, which I'll put back on. But if you look at the end of the quarter, which is going to be, let's just put it the 31st. End of quarter, which would be the exact end. Well, actually, let's do it on Friday, make it right, because the options expire on the Friday. And you see that you've got that one level at 40, which has high open interest. You've got that 50, which for obvious reasons has high open interest. And then everything in between is kind of noise. If we just stay within this area for the rest of the quarter, it makes total sense. Nothing would look untoward about that. And then I would say probably we're on the way up at that point, going into the halving. We probably have a bit of a sell-off after the halving. And then where price goes from there, no idea. People talk about all-time high before the halving. It's never happened before. And the closer we get, the less likely it is to happen again. Right? Because, Bitcoin is not likely to make a move. It's very unlikely, but nothing's impossible. It took Bitcoin, how long? 147 days to go up by 100%, right? From 25 up to basically 50. To get to all-time high from here, from current price, before the halving, we have only 77 days, and the all-time high is all the way up here, another 50, 60% higher. I just don't see that happening, and I actually don't want it to happen. It would be much better if Bitcoin builds a base before that. If it does happen, great. Balls along Bitcoin spot. I'll be happy as anyone. But I think that consolidating is probably the more likely, and just sort of consolidate but grinding higher. The direction is always up and to the right. The path is what we need to figure out as lower time frame traders. Now, the one last thing I want to look at is you have different types of price action within any market, but we're in a bull, so let's talk about bull markets. You have trend, consolidate, trend, which is a really common price action path in an uptrend. You then have the trend and then a lengthy correction before you go up again. That's a bit like what we saw here, where we trended up, corrected sideways for 7 or 8 months, and then up again. And they're the two main ones you want to look for. How deep the pullback goes can always vary, but these are basically the two. You either have a short pullback in terms of time, or you have a lengthier reaccumulation. For Bitcoin to do this, I've tested this in the past, typically it needs to be pushing up towards a breakout in about 30 days. 30 days from the peak. So 30 days from the peak here will be the 11th of Feb. Couple that with the fact that Bitcoin's price appreciation tends to happen in the first half of the month. If we are going to break out this month, I expect to see price moving up this side of the middle of Feb. 30 days, roughly. Doesn't have to be exactly 30, but if that happens, I'll be fully expecting a breakout from there. I wouldn't expect us to be trading up at that level around the 10th and 11th of Feb, which is also Chinese New Year and Super Bowl Sunday, 2 days. That would be when we're following a path something like this, right? Where we had our strong trend up, we had our sell-off, and then price just grinded up and away it goes. That was 32 days, 31 days. That's the kind of shallow pullback you're looking for in terms of time if you're expecting immediate continuation. You can even see it over here when we rallied up and we peaked out in November 2020. Then we broke out 21 days later. That was a short one. Sold off, retested the highs into the lows, and away we go. If it goes beyond that, right? Once you get beyond 30 days, if we get up to 30 days and we're sort of around here, it's much more likely to just continue consolidating, spend 2-3 months, and then away it goes. Right? That's what you're looking at for the rough paths of Bitcoin price action. I just don't see any path where it goes lower. Obviously, when I say that, of course it can go lower. I just don't think that there's enough. There's no liquidity concerns. The banking collapses are only good for Bitcoin. The Fed and the Treasury have been very clear that they're going to be accommodative. You've got an election year. I just don't see. And then you've also got the ETFs with net inflows and strong demand. I don't see any scenario currently in which Bitcoin would right now go much lower. If that is going to happen, it's probably going to happen in the next 10 days. If we go past mid-Feb and there's no collapse in Bitcoin, I think that's it. It tells us that we are either sideways or we are up into the halving. So that's pretty much it. Path 1, 2, 3. If you don't see a quick collapse, you see sideways or you see up. That's what I'm looking for. So altcoins are a different story. I think there's a lack of demand for alts. I've talked about this quite a bit, but you've seen a lot of new projects launch. This is very common. We had 3 months of up-only price action, and now people are kind of just throwing shit at the wall, and they're all launching their new projects. But when you have all these new projects launching, we've had Jupiter, we've had Celestia, we've had Jito, we've had Pith, we've had Ondo, we've had Zeta, we've had fucking endless amounts. That's a whole bunch of new projects with the same amount of money chasing them. That's bad. It fragments liquidity. Think of it really simple. Back when the market was just Bitcoin, only Bitcoin could go up. Then it became Bitcoin and 10 shitcoins. And that money has to come out of Bitcoin to go into the shitcoins. Right? Unless you keep bringing in brand new capital all the time, which doesn't happen. Brand new money doesn't just keep coming in, overwhelming what's already here. You fast forward 2015, 2017, 2019, 2021, more and more and more and more. You go from 10 altcoins to 100 to 1,000 to 10,000. It's literally exponential. Every cycle, there's a factor of 10 more. We now have more than 10,000 alts. We did not have that even 3 years ago, and then 6 years ago, and then 9 years ago. So it's just getting more and more fragmented. That's the thing you want to look at, which is fine as long as new money keeps coming in. But it's not going to. The fastest horses will always win. And eventually, you get into this scenario where you have this hot ball of money, where you've got this one big pool of billions of stablecoins. And you can look at this on the stablecoin market cap, where you go and look at USDT, USDC, and I just do it with USDT, USDC, and DAI, the 3 main stables. Go to a weekly chart. Keep an eye on this. This is bullish, right? Don't need to tell you what happened after the halving in 2020 with all the money, liquidity injections. Stablecoins went from literally 10 billion or less than 10 billion all the way up to 140. So about 15x in the stablecoin market cap, including then the rise of the market itself. But this is a $1.7 trillion asset class, and there's only 128 billion of actual stablecoins. So a lot of this is going to be detrimental to shitcoins. Certain shitcoins are just going to underperform. That's just going to happen. That's not bad. That's just the nature of the market, and you have to pick correctly. And my bet is AI, and I think that the data is bearing that out. But you want to keep an eye on this. If this keeps rising, all good. If this goes sideways, expect consolidation. If this goes down, expect declines. But I think this is not like a chart that you do TA on. This is very much, when it's going up, it will keep going up. When it's going down, it will keep going down. When it stops going down and it starts going up, it will keep going up. And it flows perfectly with the cycles. If you even just go to a monthly, it flows perfectly with the cycles. It was broadly, just stablecoins are pretty new back in 2019, 2020. That was coming out of a bear market into a bull. Big bull, bear market. Bear market ends, back into bull. And I expect this to just rise, new all-time highs, Tether going over 100 billion, USDC going over 50 billion probably, and away we go. So last thing I'll look at is the sectors. So sector by sector, we're looking at altcoins. Where do I have them? I have them here. This is since the bottom. So after the ETFs, which was the 11th of Jan, we sold off for about 11 or 12 days, bottomed out on the 23rd of Jan, And since then, so off the lows, what has been performing best? If you look on the right hand side, you can see BitTensor number 1, Render number 2. So 2 AI projects at the top. You've then Lynx, AVAX, Sol, and then Akash, another AI. So the AI projects are definitely the strongest in the market at the moment. Outside of that, there's no clear correlation. You've got Link, Avalanche, Solana, Stacks, Picasso, Phantom, Arbitrum, Injective, Uniswap, Lido. So I've picked a bunch of coins from different sectors, from AI, from real world assets, from layer ones, from BRC20, Bitcoin coins, from restaking, from old coins, dinosaur coins, meme coins, gaming coins, liquid staking tokens, NFTs, a whole range to give an idea of what's actually performing. And it's clearly AI. That's been driven as well by the fact that Nvidia, the biggest AI stock in the world, is ripping brand new highs, and the whole market is just getting to terms with this massive AI bubble that we are in. So everything that Bitcoin, or everything that crypto can be outside of Bitcoin, lends itself towards AI. I've said this before. If AI grows as an industry, so does AI crypto. If AI, centralized AI, like OpenAI and all that, if that gets attacked by the government with regulations, that's bullish for decentralized AI. The more these people get themselves attacked by the governments with regulation, they're going to push the actual builders, the real AI devs, they're going to push towards decentralization. Because it's the only way to ensure a fair system within this new technological advance. This is the, like, if you remember, you probably won't remember it, but the internet. The internet, when it started, was open source. That was why the internet blew up. Right? It wasn't, when the internet launched, or when the internet became a thing, it wasn't like Facebook, Netflix, Google, and all these tech monopolies. They came decades later. The initial explosion of internet was all open source. It was, here's this brand new thing, we don't even know what to do with it. Here's all this code, this open source programming languages, and just go and see what you can do. And it sparked a boom, a massive boom, obviously the dot-com bubble, but then after that, a real boom of new tech. I think that's where we're at with AI. It starts off with just the fundamental, developments, and then it pushes, as you can see, pushing towards centralization with OpenAI and Anthropic and all these other ones, and then decentralization through crypto. Whether it ends up being that crypto changes the world or not, we don't care. It doesn't really matter, because all that matters is the speculation element. And if there's going to be something that's going to capture hype from VCs, hype from Wall Street, hype from normies, it's going to be AI. Everybody knows about it. It's hot. So when they see AI pumping, they're going to feel FOMO. They're going to want to get in. I don't see any change in that. That has been my base case for a year. Nothing has changed. If anything, it's only gotten stronger, because clearly AI has been the best. And if you want to bet on other stuff, sure. But I just don't see anything anywhere near as strong. Layer ones, okay. Gaming, yeah, tried and failed several times. Maybe. Gaming's probably like the next best chance of something big happening. DeepIn, which kind of bleeds into AI for sure. Decentralized physical infrastructure networks, sure. Layer ones and layer twos, DeFi. Right, DeFi has already been done. Layer twos, normies are just never going to understand them. I just see AI as being so clear and so obvious. And that doesn't mean, does that not mean it's crowded? No, because there isn't actually a massive amount. There's not a great selection of AI projects yet. That's why I'm so bullish on Akash. And also BitTensor looks pretty good, because there's not a big suite of options yet, which is great. Because a lot of people are investing in all these bullshit scams. Oh, look at this one. It's 30 million market cap. It's just like BitTensor. Or it's just like Render. Or it's just like Akash. But it's not. It's just some new shit that launched that's probably going to go to zero. We don't know that, but the market will tell us. So for me, as I look at this, zoomed out overall, AI is where to focus. Also, there's a decent chance that ChatGPT 5 might come in March, because ChatGPT 4 came in March last year, and they've said that they've talked about publicly that they want to operate on a yearly release schedule, just like Apple does with the iPhones. Apple Vision Pro also, by the way, is quite big for this, because it leads into kind of augmented reality, and it kind of pushes forward this narrative about AI as well. and the Vision Pro was launched, and it's a lot of hype, and you can see the correlation, positive correlation between both AI coins as well as some gaming and metaverse coins whenever Apple does these releases. So the world is pushing towards that. That's where all the tech development is happening. Augmented reality, artificial intelligence. Those are the sectors. Keep an eye on them. Stay focused on them. Keep researching. There's a couple of projects that are interesting. Modulus, I talked about this, I mentioned it in trading analysis. Doesn't have a token yet. Modulus is one, and the other one, the name has escaped me. It doesn't have a token yet either. Let's see, it'll be in trading analysis if you want to go and do some research. Oh yeah, it's IONET. IO.net. It's one on Solana. I'm not bullish on that. I can explain that later in a research video, which I will. It seems like a bit of a cash grab. But if it's AI, it's on Solana, it probably gets hype, and when they get a token, it probably goes fucking massive. Who knows? Anyway, that's pretty much it. Liquidity looks good. I think the Fed was a non-event. I think Bitcoin is the best hedge against all this banking fuckery. So more banking fuckery is good for Bitcoin. I think liquidity for altcoins is going to be low for a while, so I'm not particularly bullish alts. I'm very bullish Bitcoin. I think a big Bitcoin dominance run can be coming. But in alts, it doesn't mean that every single alt is shit. In alts, there are many that have good setups, and the ones I see best are AI. And so as long as the market kind of remains, if Bitcoin remains in a consolidation, lows of 40, highs of 45 or 6, I think that's going to be really bullish for things moving forward. All right. So as we go towards, let me find this AKT Bitcoin chart. As we talk, since I'm on the topic and I got the alert, and sorry for your eardrums, AKT on the Bitcoin chart is just incredibly strong. And I'm expecting this to put in potentially a big breakout maybe this month. I don't know. It's just been, progressively stronger and stronger and stronger against BTC. And I think there's some real signs of strong accumulation of a cash itself. We'll see. That's probably something more for a daily levels or a weekly outlook. So that's it. GM. Accumulation continues. You should be hoping that things stay down, things stay sideways, that total 3 stays in this range, right? You want to see total 3 continue to consolidate. Really nice rally off the lows, nice sideways correction for a month. Now we're in a weekly consolidation. The longer it stays here, the more time you have to accumulate your alts before the next big leg up. And the longer it builds a base here, the better that push will be. So that's it. GM. See you all on next week's weekly outlook and on next month's monthly preview.